Chapter 6, Taxes and Tax Planning. Any government that needs to raise revenue and has the legal authority to do so may tax. Tax jurisdictions reflect government authorities. In the United States, we have federal, state, and local or municipal governments that impose taxes. So you can see here, there's the federal, the state, and within the local, that could be at the county, township, or city. In other parts of the world where there are regional economic alliances, such as the European Union, may also levy taxes. Theoretically, people with higher incomes should be able to pay more taxes and should be willing to do so, since they've been more successful or have benefited more from the economy that the government protects. In the United States, our income tax is a progressive tax, so the higher the income, the greater the tax rate. Now, the percentage of income that is paid in taxes increases as income rises through brackets or ranges. So these tax brackets are ranges where different levels of income are taxed at different rates. And unfortunately, a lot of people are very confused by the concept of tax brackets. So we'll see a video in just a moment that will explain it further. Now, taxes can be levied on income from multiple sources. So that could be from your wages or salary from you selling labor. Your interest, dividends, and gains from investments are taxed. If you're self-employed or own a business, that also gets taxed. Any property rentals, if you've got any royalties or where you're renting out your intellectual property, and other sources like alimony, gambling winnings, and prizes. Now, you're likely very familiar with the concept of a sales tax or consumption tax. That's the tax on goods consumed by us, the taxpayers. These are imposed by state or local governments. We don't have a national sales tax. Sales taxes are thought to be more efficient and fairer in that how you consume reflects your income. However, there are opponents to the sales tax. They argue that it's a regressive tax because those with lower incomes end up using a higher percentage of their income on non-discretionary purchases than higher income people do. In other parts of the world, if you ever get the chance to travel to Europe, for instance, they have something called a value-added tax. And it is a consumption tax, but it differs in that it's paid only by the consumer as an end user. So with a VAT or GST, goods and services tax, the value added to the product gets taxed at every stage of production. And governments use the VAT or the GST instead of the sales tax in order to spread the tax burden among producers and consumers. And thus it reduces the incentive to evade the tax. Note that as a tourist, if you go to Europe, you can get a refund on some things that are eligible depending on the dollar amount, and get a refund on that VAT tax. Excise taxes are taxes on specific items like alcohol, cigarettes, fuel, and in some states, these taxes are justified by the discretionary nature of the purchases and may be criticized as a way of, affecting people's behavior. So trying to get people to smoke less or drink less, these taxes impact people's decision making. Then there's property tax. These are used typically by local, state, municipal, county governments, and they're commonly imposed on real property like land and buildings, but it can also be on personal assets like vehicles and boats. So the idea is that the property values reflect wealth or your accrued income and thus your ability to pay taxes. And then with estate taxes, these are the taxes on the transfer of wealth from someone who has died to a living person. Estate taxes are usually imposed on the very wealthiest because of their unusual ability to pay, and because death and the way they disperse property is legally a matter of public record, so it's easy to collect on those taxes. Estate taxes are thought to be controversial because they can be seen as a tax on the very idea of ownership and on incomes that have already been taxed and saved or stored as wealth and properties. So when we put it all together in this chart here, you can see the different types of tax that were mentioned and at what levels of government they get imposed by. Let's go ahead and watch this video that explains how tax brackets work.
Have you ever heard somebody worry that getting a raise would bump them into a higher tax bracket? The idea that having a higher salary could somehow mean making less money sounds wrong, and it is. This fear is based on a common misconception about federal income taxes. So let's look at how tax brackets actually work. The main misconception is that being in a certain tax bracket means that all your income gets taxed at that rate. That's not how it works. U.S. federal income taxes are progressive, which means additional income is taxed at a higher rate. But, and here's the key, tax rates are marginal, which means not all your income is taxed at the same rate. Income is actually divided into different levels or brackets that have different tax rates. Each dollar of income is only taxed at the rate of the bracket it falls into. Think of these brackets like a series of buckets. Each bucket holds a certain amount of money and is taxed at a certain rate. The government determines the size and rates for each bucket and usually adjusts them each year. The ones we're showing here are for 2020. So, suppose your taxable income was $55,000. As of 2020, the first bucket holds $9,875 and is taxed at 10%. Then, in the next bucket, you pay 12% on $30,250, and so on. The rate of the highest bucket your money starts filling is your marginal tax rate, what people often call their tax bracket. So, in this example, only $14,875 of taxable income is taxed at 22%. But because your income falls into multiple tax brackets, the overall rate you actually pay is typically much less than the marginal rate. The percentage you actually pay in taxes is called your effective tax rate. However, determining your effective tax rate is more complicated than just taking your salary and averaging all the brackets it would fit into. That's because not all your income actually gets taxed. There are exemptions and deductions that could reduce the amount of income that's taxable. You could also get credits that reduce how much you owe. We won't get into the details in this video, but the IRS provides calculators that can help you determine your taxable income. The important thing to understand is that your effective tax rate is the total amount you paid in taxes divided by your taxable income, which accounts for things like deductions. So next time you worry about which tax bracket you fall into and how big that new percentage is, remember that it's just your marginal tax rate. Your effective tax rate, the amount you're actually paying, is likely much lower.
The U.S. government relies most on the income tax. So let's talk about the different taxable entities and individuals. With taxable entities, we have 4 in the federal system. That's the individual or family unit. So if you're doing your own taxes, that could be you. Or if your family is doing your taxes and you're a dependent, that would be your family unit. Then there's the corporation, the nonprofit corporation, and the trust. While you might not own a corporation or nonprofit corporation, you could still be affected through corporate profit that might be distributed to individuals as a dividend or a portion of corporate earnings that is received by a shareholder. So if you hold any stocks, this would be an example of that. Now, as for a trust, that's a legal arrangement whereby control over property is transferred to a person or organization known as the trustee for the benefit of someone else, the beneficiary. If you're the beneficiary of that trust and you receive a distribution, that money would be taxable as individual income. Now let's dive a little bit deeper into the concept of the individual entity. You can be considered single, never married, widowed, or divorced. You could be married, filing jointly. So that's 2 adults filing together as one taxable individual, and you're combining all your taxable activities, incomes, deductions, exemptions, and credits. You could be married but filing separately, so the 2 married adults file as 2 separate taxable individuals. Or you could be a head of household for a family of 1 adult with dependents. Now, depending on these filing statuses, some taxes are levied differently based on assumptions around your family structure and how that structure affects your ability to pay taxes. Now, all potential taxpayers have to declare income and show their obligations to the government. So here is a screenshot of the Form 1040 that you would fill out, and this is from 2022. So you can see up here is the filing status. So you would mark off single, for instance, and then fill out the information below. Here you can see this is the section on income. Here's the tax and credits, any payments that you might have made, and then this is how much for refund or what you may owe, and then you'll sign off. If you have someone doing or preparing your taxes for you, they would fill out the bottom here. So here's just an example of the tax brackets and their rates in 2021. So you can see here on the left, when we look at a table like this, you'll see the tax rate that applies to each of the brackets, or if we recall in the video, the bucket where the money goes into, right? So it starts at 10% and goes up to 37% here. In general, the tax rates, the percentages don't change year over year, but rather the tax brackets or the dollar amounts will get adjusted by the federal government based on things like inflation or legislation. So here in this column, if you are a single tax filer, this is how the tax rates would get applied at the different dollar amounts. And then here's the column for married filing jointly, married filing separately, and then head of household. And so when you work on the homework this week, I have a video that will help you step by step through the math on how to determine the amount of taxes owed at the different filing statuses. Note that they are using 2021 federal tax brackets, but if you're curious, you can take a look at what the 2022 tax bracket looks like. TurboTax has this great calculator, and you can see what the brackets are and what you would owe potentially. I'm going to briefly go over the different schedules that might impact you someday in the future, just so that you're aware they exist. Aside from the typical Form 1040, there could be a Schedule B on interest and dividend income if you are selling liquidity, like your savings account, certificates of deposits, or bonds. So maybe you have a CD or bond. Schedule C is for business income from self-employment or other entrepreneurial ventures or business enterprises. And if you're a sole proprietor, this might be your primary source of income. The Schedule SE, or the self-employment tax, is an additional tax on income from self-employment or business income by a sole proprietor. Schedule D are capital gains or losses from investments that come from changes in asset value during ownership between the asset's original cost and its market value at the time of sale. Again, this could be related to selling stocks, for instance. Schedule E is rental and royalty income that is earned from renting an asset, either real property or creative work like a book or a song. And then there's the Schedule F for farm income, and that's income from growing food, livestock, or livestock products like wool to sell. Now, recall in the tax bracket video, how much you make or your income doesn't necessarily mean that's your taxable income, because deductions, exemptions, and credits may apply. So deductions are tax breaks for incurring certain expenditures or living in certain circumstances that the government thinks you should not have to include in your taxable income. So this helps to reduce the taxable income amount. Examples of this might be mortgage interest deduction. So the interest that you pay on your home mortgage can be deducted as a tax deduction. Other deductions include medical and dental expenses, job-related expenses, and property taxes. Now, when dealing with deductions, you can choose to itemize your deductions, meaning you are listing out or detailing each one separately, like the examples that I mentioned, in order to calculate the total. Or you could take a standard lump sum deduction that has been set by the federal government. Whichever one is bigger, that's the one you want to take, because the bigger the deduction that you're taking, that means the lower your taxable income. So when I do my taxes, I always do both. I first itemize it to see what that number looks like, and then I take a look at the standard deduction and compare the two numbers. Exemptions are made for dependents as non-discretionary expenditures. So these are usually children, but they could be elderly parents or disabled siblings. Generally, it's relatives who cannot care for themselves financially. Like a deduction, exemptions help to reduce your taxable income. And the reason why the government offers these exemptions is because they want to encourage individuals to care for these dependent parents, children, siblings, because if you're not taking care of them, then the government would have to take care of them. After deductions and exemptions are used to subtract from your adjusted gross income, and that will leave you with your taxable income. So that should be an amount that is lower than your gross income. Now, you might get some tax credits. These help you reduce your overall taxes owed, or the amount that you were going to pay to the government. Two great credits that you should check out that might be applicable to you in the near future is the American Opportunity Tax Credit and the Lifetime Learning Credit. With the American Opportunity Tax Credit, this covers the 4 years of post-secondary education. So this would cover undergrad. And depending on your income, you can receive up to $2,500 of the cost of qualified tuition and course materials paid during the taxable year. Whereas the Lifetime Learning Credit is for post-secondary education as well, but it can be used on any years of post-secondary education, not just undergrad. So it could be used for like a master's degree, for instance. And it's also even available for people who are not pursuing a degree. This credit could be as high as $2,000 per eligible student, and there are like income eligibility requirements. Let's talk about payments and refunds. So when you're working, you'll notice on your paycheck that there is a withholding tax. So that's the money that your employer will deduct from your gross wages and pay directly to the government on your behalf. If too much is withheld, then you're likely going to receive a tax refund when you file your taxes. And if not enough is withheld, then you owe money, or you owe tax money to the IRS. How does your employer know how much to withhold? Well, when you fill out your paperwork with your employer, your Form W-4, you will determine how much taxes are withheld. So if you've paid more during the tax year than what you actually owe to the government, then you'll get a refund. Let's talk a little bit more about the IRS. That's the Internal Revenue Service. They enforce the federal tax laws, which are written by U.S. Congress. The IRS is part of the U.S. Department of Treasury and is responsible for collecting tax revenues. In order to collect these tax revenues, the IRS must inform the public of its tax obligations and come up with a system that allows for the collection and verification of tax info so that collectible revenues can be verified. In other words, the IRS has to figure out how to inform the public and collect taxes while also collecting enough information to be able to check that those taxes are correct. So after you file your tax return, it'll get processed and reviewed by the IRS. If you're owed a refund, you'll get your money back. If you paid a payment, it will be deposited. And the IRS reviews returns for accuracy based on that redundant reporting and its sense of your data. Now, the IRS could investigate any discrepancies between the wages you report and the wages that your employer reports. The IRS can also follow up by mail or by personal interview. They may just ask for verification of something, or they could conduct a full audit, which is a thorough financial investigation of your return. For example, when I did my solar install and I got the credits for that in my tax return, the following year, I had the IRS contact me for verification. They wanted to verify that I really had solar installed. So they actually used Google Earth to take pictures of my roof to see that I had solar panels installed and that I was the owner of that house. When it comes to keeping records, employers are required to send the Form W-2 to employees at the end of each year, which usually arrives in your mail, maybe like January. And then you should also hang on or receive any Form 1099s for other kinds of income, like interest and dividend income that your bank or brokerage firm may send you. Both the W-2 and the 1099 forms are reported to the IRS and to you. Other records or receipts that you would want to hang on to as it relates to deductions could be charitable gifts. So if you donate money to church, or let's say you donate your old things to Goodwill, you should get receipts for that so that you can put it in your tax paperwork. If you've got medical and dental expenses, you want to keep those receipts because those potentially could be deducted. And then with job-related expenses, if let's say in your job you have to buy equipment or you have a home office, you could also potentially deduct that as well. You just want to keep the receipts. Now, with tax preparation and filing, again, most taxpayers are filling out the Form 1040 or 1040EZ, and as needed, those schedules I mentioned before. But for some taxpayers, they want to hire a professional tax preparer. And these pros can be a lawyer, an accountant, could be a personal financial planner, could be a tax consultant. And the kind of tax preparer that you want to use really depends on the tax activities that you're doing and the kinds of advice that you're looking for. For those that choose to do their return on their own, you can use tax preparation software like TurboTax or H&R Block. And the IRS also has a free tax prep and filing software called IRS Free File if you want to check that out as well. Either way, whether you are doing your own taxes or having a professional tax preparer do them for you, you are the one signing your tax return and you are assuming responsibility for its details. And in terms of follow-up, after you've submitted your tax return, you could experience a full audit, which is that thorough financial investigation of your return. And that's why it's important to keep records and receipts so that if they ask for it, you have all your information to provide them. Now, it's important to know the difference between filing strategies of tax avoidance versus tax evasion. One is acceptable and one is not. So with tax avoidance, this is the practice of ensuring that you aren't paying extra in your tax obligations. So you're trying to minimize or avoid tax obligations, and this is considered perfectly legal. Whereas tax evasion is when you are lying or fraudulently reporting tax obligations, such as understating how much income or gains that you made or overstating your expenses and losses. So if you're lying about your numbers, that's considered illegal. One common tax avoidance strategy could be the timing of incomes or expenses so that you could take advantage of changing tax circumstances. So for instance, if you made a lot one year, you could defer some of that income for the next year so that it doesn't impact your, let's say, tax brackets. There are a number of tax strategies to be aware of and to consider as things change in your life, whether it's the amount of income or expenses or the kinds of incomes and expenses that you experience. So for instance, buying a home is a common tax strategy because of the deductions in the mortgage interest or the property tax. As you set aside money for your retirement, for instance, in an IRA, that has tax implications to help you out, or for instance, education financing or even health financing. There are options that your employer may offer that will allow you to set aside money pre-tax to help pay for medical expenses and such. So being aware of those tax strategies and using them to your advantage. Now with life stages, again, for young adulthood, your source of income is your salary or your wages, and the adjusted gross income and the deductions and exemptions available to you tend to be on the lower side. Whereas in middle adulthood, your adjusted gross income should theoretically be higher as you are in your career, and you'll likely have more deductions and exemptions, for instance, like having children. And then in older adulthood, your gross income should be at its highest, and you should still have some deductions and exemptions. And when you're in retirement, you're not working anymore, so your AGI will be lower, and your deductions and exemptions will be relatively low as well. And in future chapters, when we talk more about home ownership and retirement, I'll make sure to talk about the related tax strategies as well.